This is forexbrokers.net, and we move on with our trading academy with a topic very dear to all retail traders. It's called the trend is your friend, or is it true that the trend is your friend? And you can find more details on the article part of the Trading Academy. I would like here to actually show what a trend is and what makes a trend, and especially when a trend is invalidated, what a trend line is, and how to make the most of a trend. This is the Australian dollar and US dollar on the daily chart, as you can see here, and it moved to the downside from January 2018 all the way until 2019 in November. It moved to the downside relentlessly with decent spikes to the upside. Keep something in mind when you trade not only the currency market, but when you trade any kind of a market. Rarely the market moves in a straight line like this, in a vertical line, either to the downside or to the upside. Instead, it forms a series of swings or market swings that are part of a trend. These are corrections that the market forms in order to book some profits, or for some traders to book partial profits. You know, when you sell something, for instance, you sell here the Australian dollar, US dollar, in order to book the profit, then you need to square your position. When traders square their positions, the market bounces a bit. Some late bears will be squeezed or stopped, and so on. A trend is a series of, let me take a shape here, is a series of, this is a low, and then the market forms a what? This is the maximum high. The market forms a lower high, then it puts a lower low when compared with this one, a lower high as well, lower low, lower high, lower low, low high. This is what makes a trend. Why is it said that the trend is a trader's friend? Because as long as this series holds and is not broken by the price action, going on the long side, on the opposite side, is the riskier trade, or is riskier than staying on the short side, despite the fact that sometimes such a bounce may take a long time. For instance, from here, this bounce, it took from the 25th of October all the way until the 3rd of December. So here, during this period of time of 1.5 months, the Australian dollar and US dollar actually was quite bullish, but as a matter of fact, it was only part of a bearish trend. Now, how do we define the trend? We define the trend using a trend line. A trend line, like the name suggests, is the line of a trend. It connects 2 points. All you need for a trend line is 2 points, and then from those 2 points you drag the trend line on the right side of the chart. Typically the trend line starts from the highest point, I mean during a bearish trend, from the highest point, and then you connect what? You wait for the market to form 2 lower lows. So this is a low, then you have a lower high, and then a lower low. Already this is a trending condition. So you connect these ones and you drag it like this. And we see that the market comes. Remember, at this point, we don't know this price action. We don't know anything that formed here. Anything. So at this point in time, what the market does is it breaks this trend line here. At this moment, the key here is for the price not to break the conditions of a trend, not to break this lower high. So while it broke the trend line, it failed to break the rules of a trend, or the lower high, and then it formed another lower low. What to do next? Nothing, but we do not connect the highs with this lower high anymore, but with this lower high, because the market was strong enough or weak enough, because this is a bearish trend, to make a new lower low, and then we drag it to the downside. We see that the market comes back again, breaks this trend line, but fails to make a new to break the series, and after that makes a new lower low. This is the new adjusted trend line. The same happened here. This is the new adjusted trend line. the market formed a new lower low, and then we keep dragging the trend line to the downside, following the same rules, and up to this point it should be here. We see that this move higher while breaking this marginal lower high was followed by a new lower low. So our trend is alive and kicking, and we drag it all the way to here. Following these rules, we come to the current trend line. This is the current trend line on the Australian dollar and the US dollar. Let's make it like this, more visible. And we see that the market broke it here. So what would be the focus in order to see a trend reversal? Because here the market put in a potential double bottom, like a move lower, another move lower around the same area, and the bounce. It looks like a double bottom. We will cover the double bottom a bit later in this Trading Academy, and we'll explain it exactly what it means. But the double bottom, in order for it to be in place as a reversal pattern, the market needs to go and break this series. Why? If it breaks this high, then it means that it invalidates the bearish trend. Until then, the Australian dollar, US dollar is just bearish as bearish can be. Keep in mind that as long as the market keeps forming lower lows, then trading in the opposite direction is riskier as riskier can be. During a trend formation, besides the rules of lower lows, the rule of lower lows and lower highs, you should also, or we can also project the trend lines in the opposite side of the trend, something like this, in order to find out potential channels, in order to find out channels to trade either to the upside or to the downside. Thank you for being here, and bye bye.